when somebody says tax returns, our brain switch just turns off. Because who will do all that paperwork? Plus, it's so complicated. But think about it. We are already paying so many taxes. Taxes on food, taxes on clothes, taxes on travel, taxes on movies. So, bhaiyo aur behno, it is time to turn that switch back on. Because by doing our taxes, we can save a lot of money. And that in turn will get us more money. It's just like setting up a money tree. I know the concept is sounding like a fraud, but trust me. Today I'm going to tell you 5 legal ways of saving your taxes and growing your money automatically. So in today's video, we're going to see what is tax and how much are we paying. 5 legal ways of saving taxes. But most importantly, towards the end, as a bonus tip, I'll show you how to do your tax calculations so that you pay the least tax possible. And I'm going to do all of this without boring you to death. But before that, if you like me or if you like my work, make sure you hit that like button because that motivates me to make more videos. Let's begin. Now what is tax? Suppose you are earning X amount of money. Out of that, you have to give away some to the government so that it can use it for public services. Now we can't control how and where our government is using our money. But the Income Tax Department of India gives us back our money if we save more money. Isn't that great? Before I tell you how, let's first understand how much are you paying in the first place. It all depends on the tax slab you fall into. If your income is less than 2.5 lakhs per annum, then you pay 0% tax on your income. If it's between 2.5 to 5 lakhs, then you have to pay 5% tax on your income after you deduct 2.5 lakhs from it. For example, suppose you're earning 4.5 lakhs per annum. Subtract 2.5 from it. Because for 2.5 lakhs, you don't have to pay any taxes. What's remaining? 2 lakhs. Now you have to pay 5% of 2 lakhs, which is 10,000 rupees. And that is the income tax you're paying. If your income is between 5 lakhs to 10 lakhs per annum, then you need to pay 20% income tax. And for more than 10 lakhs, it is 30%. This tax slab is different for senior and super senior citizens. So as you can see, 30%, 20% and even 5% is too much. Especially when we are paying GST for everything. Food, clothing, travel, petrol, internet, electricity, movies. It's like we are paying taxes for breathing. So if the income tax department itself is giving you back your money, that is rebating your money, then why won't you take back your own money? Now how to get back your money? There are 5 ways to do it. The first method involves spending money a certain way, and the rest 4 are by saving it. Let's start with spending money. The income tax department will give you back your money if you spend it on the following things. A. House rent allowance. In your salary slip, you would have noticed there's something called HRA, House Rent Allowance. If you're paying rent, then under section 1013A, you get an exemption of an amount that is equal to the minimum of these 3. Your HRA in your salary slip, 50% of your basic if you're living in a metro, or 40% of your basic if you're living in a non-metro, or the rent paid by you minus 10% of your basic. To simplify this, let's take an example. Suppose you earn 50,000 rupees per month. Your basic is 25,000 and according to your company policy, your HRA is 40% of your basic, which is 10,000 rupees. So we are assuming that this is how your salary slip looks like. So option 1 is direct. HRA is 10,000 rupees, which we directly picked up from your salary slip. Option 2 is same as option 1 because your company decided that your HRA is 40% of your basic, which is what most companies do. Time to calculate option 3. Let's assume you pay 7,000 per month as rent. So 7,000 minus 10% of your basic, which is 2,500, gives you 4,500 rupees. Now among 10,000, 10,000 and 4,500, which is minimum? Obviously 4,500. So 4,500 into 12 equal to 54,000 rupees is your tax exemption. Now remember this 54,000 because towards the end in the bonus tip, I will show you how this 54,000 will reduce your taxes. Moving from rent to home loan. Suppose you're living in your own house and have a home loan on it. Then congratulations because you can claim both principal and interest. Under section 80C, you can claim the principal and the maximum limit of 80C is 1,50,000 rupees. Under section 24, you can claim the interest and the maximum limit is up to 2 lakhs. Third expense, provident fund. This is something you have to contribute in while you're working. The best part is it comes with a tax exemption under 80C. So your PF is usually 12% of your basic. If we take the example of this salary slip, then 12% of 25,000 will be 3,000 rupees. Multiply that by 12, you get 36,000 rupees. Now remember this 36,000 also because towards the end, I'll show you how this will also reduce your tax. Fourth and the most important expense, education. Under 80E, suppose you or your spouse or your children take an education loan. Then you can claim the interest until it is fully paid or for 8 years, whichever is sooner. Which means suppose you took a loan for doing your engineering. Then you can claim it even while you're doing your job. 80E is for education loan. But under 80C, you can also claim the tuition fees of your children. Only for the first 2 kids, okay? Because hum do, hamare do. And finally, under 80G, you can file returns for a maximum of 10,000 rupees for contributions made to charitable institutions, relief funds. So if you've contributed to the Kerala CM Relief Fund, then you can claim it now. So as you can see, there's so much tax returns you can file by spending money. But if you're not doing any of these, then don't worry because Government of India allows tax exemption even when you save money also. To help you decide which of these 4 saving options is best for you, we are going to compare them based on 3 parameters. Number 1, lock-in period, which is how long you'll have to wait before you take out your own money. Number 2, average returns, which is the percentage of interest you'll get out of it. And number 3, tax on maturity, which is the amount of tax you'll have to pay on the final amount that you get at the time of withdrawing your money. Let's start with the option of saving money through PPF. PPF stands for Public Provident Fund, which is basically a retirement fund. So if you save your money through PPF, then you can save your taxes under section 80C. The sad part is the lock-in period of PPF is 15 years. And if you're in dire need of money, then you can withdraw only after 5 years and only up to a certain percentage. So withdrawal is definitely a problem with PPF. The average returns is around 8%. But the good part is you don't have to pay any taxes on the final amount at the time of withdrawal. Our next option is a tax saving FD, which is basically a type of fixed deposit that comes with a tax benefit under section 80C. The best way to invest in a tax saving FD is in a bank that has your salary account. Because that way you can automatically set up for the FD amount to directly move to your salary account after maturity without you having to do anything. Our next saving option is health insurance. I know what you're thinking. Nothing bad will happen to me. But bad luck does not knock on the door before coming. And you wouldn't want you or your family to spend all your savings or worse, beg for money. The best part about health insurance is that it helps you save taxes. Under section 80D, you can claim up to 25,000 rupees for yourself and your dependents and an additional of 30,000 if both your parents are above the age of 60. If you want me to make a separate video about how to choose the best health insurance plan, then comment below and let me know. Our last saving option of the day is ELSS, Equity Linked Savings Scheme, which is basically an equity mutual fund with tax benefit under 80C. The lock-in period of ELSS is just 3 years. Average returns in the past have been between 14% to 18%. And the returns generated are taxable. One of the best ways to invest in ELSS is through an app called Grow. I'll tell you more about it later. But before you invest, always remember, mutual funds are subject to market risk. Please read the offer document carefully before investing. Apart from these, there are other tax saving options also like EPF, NSC, term insurance, NPS, yada yada yada. But for now, we are sticking to the basics that are more than enough to get you started. Now coming to the bonus tip, how to do your tax calculations and pay the least tax possible. Now before I tell you that, make sure you subscribe to my channel and hit that bell icon so that I know you like me. And also because I make career and finance videos every week. Now comes the most interesting part. How to divide your money into these options so that you pay the least tax possible. For that, let's take an example. Suppose Raj is a bachelor, earning 6 lakh rupees per annum and paying a rent of 7,000 rupees per month. He is covered in his company's health insurance plan. Now let's see how he can divide his money so that he pays the least tax possible. With an annual income of 6 lakh per annum, Raj falls into the third slab. Now 6 minus 2.5 gives you 3.5 lakhs. He has to pay 5% tax on this 3.5 lakhs, which is equal to 17,500 rupees, which is a lot of money. Now let's see what he can do to reduce this amount. Number 1. You remember in the HRA section, we discussed how under section 1013A, for a rent of 7,000 rupees, Raj can claim up to 54,000 rupees. Let's keep this aside for a second. Number 2. Under 80C, the maximum tax exemption limit is 1,50,000 rupees. Now let's see what all Raj is spending money on that can be claimed under 80C. A. Children's tuition fees. He does not have any. B. Home loan principal. He does not have one. C. His provident fund contribution. As we calculated earlier, it's 36,000 rupees. So under 80C, you can claim up to a maximum of 1.5 lakhs. But Raj is only spending 36,000 rupees. So 1.5 lakhs minus 36,000 gives you 1.14 lakhs per annum, which is still left. So Raj decides that he will invest this 1.14 lakhs in either a tax saving FD or ELSS. Now based on these parameters, you decide which tax saving option is best for you. And if you think ELSS is your choice, then check out the Grow app. This video is sponsored by them. And the reason why I agreed is because not only they help you select the best mutual fund, but they also give you the 80C investment proof that you can submit to your HR and your savings can start from the same month. If you want to know how to use the Grow app, then watch this video. And I've left the Grow app's link in the description. Download it for free and check it out yourself. As you can see, all of Raj's investments are done. Now let's see how it reduces his taxes. To do that, we need to subtract all of this from his annual package. So 6 lakhs per annum minus 1.5 lakhs under 80C minus 54,000 rupees from HRA gives you 3,96,000 rupees. So now he has to pay taxes only for 3,96,000 rupees instead of 6 lakhs. So 3.9 minus 2.5, because you have to pay zero tax for 2.5, gives you 1.46 lakhs. And 5% of 1.46 lakhs is 7,300 rupees. So instead of paying 17,500 rupees with no investments, now Raj is only paying 7,300 rupees. Plus he has made investments that will get him more money. So he has saved money by investing money. And this cycle will generate more money automatically. So hasn't Raj built himself a money tree like we were talking about earlier? And if he can, then what's stopping you? On that note, I promise to see you again next week. Until then, keep fighting the urban fight to be fit.